Welcome back, everyone. In today's video, we're going to dive deep into the world of capital gains taxes on real estate and show you all the different strategies that real estate professionals use to minimize their capital gains taxes and keep more of their hard-earned money in their pockets. If you're considering selling a property but you're worried about potentially large capital gains tax bill, then you're in the right place. So let's get started. Did you know that a portion of the U.S. tax code is specifically written for the benefit of real estate investors as an incentive to provide housing? In fact, the tax benefits of real estate are one of the leading reasons why people choose to invest in it, since stocks and bonds, they're not very tax friendly. Today, we'll show you 4 powerful strategies to avoid paying capital gains tax when selling your property. So buckle up, because we're about to go on a deep dive into these tax-saving strategies. So what exactly are capital gains taxes? Capital gains taxes are the taxes that you owe on the profits from selling an asset, like real estate. They're imposed on the profits earned from the sale of any asset that has appreciated in value. These gains are calculated by subtracting the cost of the asset, known as the basis, from the sale price. And the tax is then applied to that resulting gain. The asset in question can be anything that has increased in value since it was purchased, such as stocks, bonds, real estate, artwork, etc. And the capital gains tax rate, it can vary depending on factors such as the type of the asset, the length of the time the asset was held, and the taxpayer's income level. In many countries, including the United States, there are different tax rates for short-term and long-term capital gains. More on this in just a bit. Overall, capital gains taxes, they're a way for governments to generate revenue from the profits earned by individuals and businesses, and they can have a significant impact on investment decisions and financial planning. There are 2 types, short-term and long-term capital gains. Short-term capital gains are the gains realized from the sale of an asset that was held for less than 1 year. Long-term capital gains, on the other hand, are gains realized from the sale of an asset that was held for more than 1 year. And the distinction between short-term and long-term capital gains, it's important because the tax rate that applies to these gains, it's very different. In many countries, including the United States, short-term capital gains are taxed at a higher rate than long-term capital gains. For example, in the U.S., short-term capital gains are taxed at ordinary rates, as ordinary income, which can be as high as 37% for individuals with high incomes, while the long-term capital gains, they're taxed at a lower rate, which range from 0 to 20% depending on the taxpayer's income level. As a result, investors and traders, they must consider the potential tax implications of their investment decisions, particularly when it comes to deciding whether or not to hold an asset for the short term or over the long term. Depending on the individual's tax bracket, it may be more advantageous to hold an asset for a longer period just to take advantage of that lower tax rate on long-term capital gains. Now let's dive into the first strategy to avoid paying capital gains taxes. It's called the 2 and 5 rule. This rule states that if you live in a house for at least 2 years out of the 5 years before selling it, you can exclude up to $250,000 or $500,000 if you're married filing jointly of capital gains from your income. This rule applies to your primary residence and can be used once every 2 years. In order to qualify, you'll need to meet the ownership and the use tests, which require you to use your property and use it as your primary residence for at least 2 years during that 5-year period before you sell the asset. The second strategy we'll discuss is the 1031 exchange, also known as the like-kind exchange. And this tax deferral strategy, it allows you to defer capital gains taxes by reinvesting the proceeds from the disposition of a property, from selling an asset, into another like-kind property within a specified time frame. That replacement property, it must be of equal or greater value, and the exchange, it must be completed within 180 days of the sale of the original property. By doing this, you can avoid paying taxes on the gains until you eventually sell that replacement property without reinvesting into another like-kind exchange. But oftentimes folks will just continue to use that kind of 1031 exchange over and over and over, so as to avoid capital gains kind of perpetually, if you will, in an effort to try to pass that investment along to their heirs at a stepped-up basis once, unfortunately, they pass away. To take this all one step further, it's actually possible to perform a 1031 exchange through a private real estate fund, and that offers investors a few unique advantages. And here's how it's done. When an investor sells a property, they can use the proceeds to invest in a private real estate investment fund that specializes in acquiring properties that qualify for 1031 exchanges through a tenant in common structure, also known as a TIC. And the way it would work is as follows. It must be a like-kind exchange. So as opposed to doing a 1031 exchange where you sell one property and you directly buy another property. That's a like-kind exchange. When folks invest in a private real estate fund, a fund is actually considered a security. And in this manner, folks can't sell one property, invest directly into the fund because it wouldn't be considered a like-kind exchange. They're actually buying a security. However, that fund can be kind of viewed as an umbrella entity. And underneath that umbrella entity are individual subsidiary properties. And each of those individual subsidiary properties, they have their own individual LLC. And each one of those individual LLCs is in fact its own entity, and therefore can have its own 1031 exchange proceeds invested into it. Whenever an investor sells their original asset, while they can't take the 1031 proceeds and invest it directly into the fund, they can, however, invest it into a subsidiary property, which would be considered a like-kind exchange. And then from that point, we could implement what is known as an UPREIT, or a Section 721 exchange, where the fund would absorb ownership of this subsidiary TIC and provide that investor with the opportunity to A, mitigate capital gains, and B, ultimately, at the end of the rainbow, get diversification into all the different assets that we own inside of a private equity real estate fund. Private real estate funds are managed by professionals who have experience in identifying and acquiring properties that meet the criteria for a 1031 exchange. The investors' funds, they're ultimately pooled together with other investors' funds, and that fund manager uses all the capital to purchase properties that inevitably meet that 1031 criteria. And since that investor is technically exchanging their interest in one property for another asset, it's a like-kind exchange, rather than receiving cash from the sale of that asset, then the transaction qualifies for a 1031 exchange. And that means the investor can defer paying capital gains taxes on the sale of the original property so long as those proceeds are reinvested within a certain time frame and other requirements are met. The advantage of using a private real estate investment fund for a 1031 exchange via a TIC is that it provides a diversified portfolio of properties that meet the criteria, which can be difficult for individual investors to identify and purchase all on their own. Additionally, the fund manager takes care of the details of the exchange, walking the investor through the process and making it a simpler process for everyone involved. Of course, it's important to note that the 1031 exchange, they have strict rules and requirements, and investors should obviously consult with tax professionals and their own investment advisors to determine if it would be the right fit for them and their families. If you guys are enjoying this video and want more tips on maximizing your investment portfolio and minimizing your tax burden, make sure to hit the like button and subscribe to our channel. Now let's move on to the third strategy, which is investing in qualified opportunity zones. These zones are designated economically distressed areas where new investments can qualify for preferential tax treatment. And by investing in these zones, in these areas, you can defer or even potentially eliminate your capital gains taxes. When you sell an asset and you reinvest those gains into a qualified opportunity fund within 180 days, you can defer the capital gains taxes until you sell the fund investment. If you hold the investment for at least 5 years, you can reduce your capital gains tax bill by 10%. If you hold it for at least 7 years, that reduction increases to 15%. And additionally, if you hold the investment for at least 10 years, you can completely eliminate any capital gains taxes on the appreciation of the opportunity zone investment itself. This makes investing in qualified opportunity zones a powerful tax saving strategy for real estate investors. The fourth strategy we'll cover is tax loss harvesting. This involves selling an underperforming property at a loss to intentionally offset the capital gains from another property that you've sold at a profit. And by doing this, you can help reduce your overall tax burden. Keep in mind here that the strategy requires careful planning and coordination, as you must offset short-term gains with short-term losses and long-term gains with long-term losses. It's always a good idea to consult with a tax professional to ensure that you're executing this strategy correctly. And to tie this all up in a nice, neat little bow, I already explained how it was possible to do a 1031 exchange through a private real estate fund. Now, we'll dig a little bit deeper here into how to invest in real estate syndications and funds for tax efficiency in general. By investing passively in real estate through syndications or funds, you can benefit from advantages such as depreciation and interest deductions. These deductions can help offset the income generated by the investment, reducing your taxable income and potentially lowering your overall tax burden. Additionally, many syndications and funds, they structure their returns as long-term capital gains, which are typically taxed at a lower rate than ordinary income. Now that we've covered these 5 strategies, you should have a better understanding at how to minimize your capital gains taxes when investing in real estate. Remember guys, it's important to always consult with a tax professional to ensure you're implementing these strategies correctly and maximizing your tax savings. Before we wrap, I wanted to remind you that we have a free gift for you in the description of this video. We're here to help as many people as possible generate cash flow and build legacy wealth through commercial real estate. And it's no secret that our favorite asset classes are mobile home parks and parking facilities. We know these asset classes like the back of our hands, and we're excited to share our knowledge with you along the way. If you want to learn more about what, in my humble opinion, is the best asset class in all of real estate, click the link in the description to get our free guide to mobile home park investing. You won't want to miss it.